Welcome to the lecture video on foreign direct investment. And in this video, I want to talk not only about transnational enterprises, which are just companies that have headquarters in one country and some kind of operation in another country, but I also want to talk about what happens when you, as an international manager, decide to make an investment in a country. Inevitably, you're going to have to speak to the host country government, the government of that country where you're going to make that investment. And necessarily, there's going to be some sort of negotiation or bargaining that will go on between the transnational enterprise or you as international manager and that host country government. So we'll talk about both of these topics in this video. First, some definitions. I use these terms very loosely and interchangeably. So I might refer to transnational enterprise, TNE, or transnational corporation, TNC, or multinational corporation, MNC, or multinational enterprise, MNE. But really, all I'm referring to is a company that has some kind of operations in more than one country. So this could be a company that has headquarters in one country and operations of some kind, business activities in another country. That's all that means, okay? And one other definition I want to make very clear right from the outset is this distinction between foreign direct investment, FDI, and portfolio capital investment. So foreign direct investment implies a significant commitment to a country, right? The company is going to put in foreign direct investment, an investment in a manufacturing plant or in a hotel. And usually that implies that the company is going to retain some sort of control, managerial control over that investment. Portfolio capital investment doesn't imply such a significant commitment to a country. That could be where an investor just decides to invest in the stock market of a country, buy some stocks or bonds in that country. And so that is not very significant as a commitment because the investor could simply sell those stocks or bonds quickly and take his money back out of that country. So usually that kind of investment is not such a significant commitment and does not imply there's any sort of managerial control over the investment. So I just wanted to make those definitions very clear. So now let's talk about why foreign direct investment happens in the first place. Why do transnational enterprises expand into other countries? And so guess what? As we've done in other parts of this course, there can be three different ways of looking at this or three different ways of explaining this. The liberal view we would refer to as the product life cycle view. And so let's talk about that view. And it says product cycle there, but you should add that word life cycle in the middle there. So it should say that. So what this view says is that the reason that foreign direct investment happens, the reason transnational enterprises move out of their own country and start investing in other countries is that it's just market forces, right? They may introduce some new innovative product into a market, maybe their home market. And eventually, though, everyone has that new innovative product, right? They've saturated the domestic market. Everybody has one of these things. So they're thinking, we need to start expanding. We need to find other markets for our goods. So they start exporting to other developed country markets. Maybe they start exporting to Europe. But then what they begin to notice, this company will notice, is that, gee, there are maybe some local competitors that are producing similar products. And we have these big transportation costs to get our product into those markets, plus the tariff barriers that a lot of countries put up. So we can't compete very well with a local competitor. So what's the next logical step? Well, manufacturing in those markets, right? And then once the company begins doing that, investing in developed markets, putting up manufacturing plants, the foreign direct investment has happened. The next stage in the life cycle of this sort of investment process is the company might say, you know what, if we really want to reduce our costs, we could invest in less developed countries, LDCs or emerging markets, and that could keep our costs down even lower. And then we could even export back to the home market. And so we see this kind of phenomenon happening all the time. What drove this? There wasn't any government telling the company to do this. There wasn't any sort of upper class person telling them you must do this. The company did this simply, it was following market forces, trying to maintain high profits. So this is why this is a liberal view, right? The idea that the government had no really significant intervention in this process whatsoever. It was market forces that drove the company to do this. Now, if we want to think about the economic nationalist view, that's where governments do interfere with the market forces to make foreign direct investment happen. And sometimes what we see is that countries that want to receive the investment, we call those the host nations, they want to host the investment, might offer big tax breaks or other kinds of incentives to try to persuade companies to invest in their country rather than another country. They intentionally interfere with the market forces to promote their own national interests. That is economic nationalism, right? So I'm calling this the economic nationalist view. Sometimes we even see countries encourage their own companies to invest in other countries. They give incentives to their own companies to invest in other nations. And the United States is one of these companies. This is very interesting. There is an organization, a U.S. government agency paid for by U.S. taxpayers called the Overseas Private Investment Corporation, OPIC. It's not OPEC, which is the oil cartel. We'll talk about that in a later video. But OPIC, the Overseas Private Investment Corporation, tells U.S. companies, hey, if you invest in other countries like Afghanistan or Pakistan or some of these other places that are where maybe the national security of the United States is important to us, we'll give you an incentive. We'll give you political risk insurance. If you lose your investment for political reasons in one of those countries, we'll compensate you for your loss. And so this is a way to get U.S. companies to promote the national interest of the United States. This is government intervention in the market, intentionally encouraging U.S. companies to do this and invest in other countries to promote the broad national security interests of the United States. So that's an economic nationalist reason for foreign direct investment. That's not just the market forces as in the liberal view, right? So the final real major view is the structuralist view or the Marxist view, where the big corporate interests are realizing that there could be a revolution, a socialist revolution at home. So they convince their governments to go take over other countries, engage in imperialism, and start exploiting those other countries so that they can move there and exploit the workers and not face any fears for revolutions in these countries that have not yet reached the stage of revolution. So that's a very strict Marxist view, very interesting side view, but that's another completely different explanation for why foreign direct investment happens. There's a more sophisticated modern view of the liberal theory, which says, well, what we see nowadays is that we'll see that there might be a big transnational enterprise, a company with headquarters in the United States that decides to put manufacturing plants in multiple countries. And the production process is in all of these various manufacturing plants, but it will keep the research and development, the proprietary know-how in the home country, because it doesn't want to leak away or give away its secrets, but it will engage in trade with its subsidiaries, its own branches of its company in these other countries, and that will be a way that it can keep itself competitive. Let's say it's Boeing trying to manufacture airplanes. They might manufacture the engines in one country, or the really research and development might be done in the United States, but then other low-cost, low-skilled kind of manufacturing might be done in other countries. And they'll do this as a way to kind of take advantage of the comparative advantage of the global economy, keep themselves competitive, and that is another reason this foreign direct investment is happening, right? So again, this is kind of a variation on the liberal view. So these are all the reasons that this foreign direct investment happens, but what is really interesting is once the foreign direct investment happens, or let's say you as a manager decide to engage in this foreign direct investment, well, you're going to have to speak at some point to the government of that country, the country that's going to receive the investment. Now, we have noticed that there is a very interesting phenomenon that can happen. Often governments of countries are very eager to attract foreign direct investment. They would like to have a manufacturing plant. It brings jobs, it brings opportunities, it brings investment capital. So often these governments will offer big incentives. As I mentioned before, sometimes countries will give tax breaks or free land or other things to try to persuade companies to invest in their country. And so what we have noticed is that there can be this very good bargain that is struck by the transnational enterprise, that it might go to some country. This could be you as a manager. And you could be negotiating with a host country government and you're saying, gee, they're giving us great tax breaks and all kinds of incentives, free land to put our manufacturing plant here. But then what can happen is that initial bargain that you struck, maybe for a 5-year period, we'll get a free taxes for 5 years. Great deal. You come back, you tell your boss about it. Well, 5 years later, you go back to renegotiate the contract, and you find that the government is putting all kinds of demands on you and saying, we're not going to give you the same incentives as before. We're not going to give you the same terms for your investment that we gave you before. We're going to demand higher taxes, and we're going to demand you do this, and you hire this number of people, and you do that. And you're saying, oh my gosh, what happened? We lost our bargaining power, right? And so what we notice is that in some cases, we'll see that T&Es will experience what is called the obsolescing bargain. And there was a very famous professor at Harvard Business School named Raymond Vernon who really developed this concept of the obsolescing bargain. And he noticed that often this happens in certain kinds of industries where the companies, the transnational enterprise is just going to go extract raw materials out of the ground, let's say a mining company. That it often happens in, let's say, even petroleum extraction kinds of things. Oil extraction companies experience this a lot. And so Raymond Vernon, he called this the obsolescing bargain. And what he said, what he meant by that was that the initial bargain the company strikes with the host country government might be very favorable to that company. But over time, the government gets more and more bargaining power. And the initial bargain becomes obsolete, out of date. It's no longer relevant. Things have changed. Now the host country government has all the bargaining power. And so this is a gradual process. So this process is called the obsolescing bargain. And so if we look at this, when we think of this, the transnational enterprise, or T&E, has some advantages at the outset, right? Think of a copper mining company negotiating with a host country government in a poor country in Africa, let's say. The transnational enterprise might initially say, look, you need our skills, you need our capital, you need our know-how, our access to markets to get that copper out of the ground and to sell it in other places. You need us to do this. But the host country government, the government of the country that's going to receive this investment, might say, yeah, but we have control over the copper. We have some control over labor force regulations and over taxation policies. We can decide if we want to give you a tax break or not. So I think what is interesting in this scenario is that what we find is that in this kind of situation, often the transnational enterprise initially has the bargaining advantage. And the poor host country government is at a disadvantage, and it will offer all kinds of great incentives and anything to lure that foreign direct investment to that country. But over time, that initial bargaining advantage becomes obsolete, right? It's no longer valid because the bargaining power has shifted in favor of the host country government. And so I think what is interesting is that this is such a common phenomenon. It's a very famous phenomenon known as the obsolescing bargain, and every international manager should know this concept. Why does this happen? There's 3 main reasons that this happens. This shift in bargaining power takes place away from the T&E to the host country government, and you as an international manager should know about this because you might find yourself facing this situation someday, right? So here are the 3 main reasons. The first one, and I'm going to try to use my little pen. I have a little pen here to see if I can mark these. There's the first one, right? Reduction of uncertainty. And what happens is that as you decide where you're going to invest, you start negotiating with the host country government. Initially, the government says, well, we would love to have you invest here. Please come to our country. But you say, but it's very risky. We don't know if we're going to find any copper. We don't know if we're going to be successful. We don't know how things are going to work here. You have to make it worth our while. You have to make it very attractive to us. You offer us big tax breaks to convince us to come to this risky country. Well, if you do invest and you make a lot of money, you find all kinds of copper, in 5 years, the government's going to say, well, we had to give you those big tax breaks because of the big risk, but now there's no risk. You're making all kinds of money. We could demand higher taxes from you. There's no risk involved anymore. And by the way, now other companies are noticing your success, and they're willing to invest in that country too. And now the government can play one company off of another to take advantage of that. So you see this kind of thing? So this reduction of uncertainty over time works against you. And so managers of big companies that are very successful have told me again and again We play this up, the risk and the uncertainty, because that gives us great bargaining power in the outset. But over time, as the company, if we're successful, the government realizes, gee, there's no risk, and they won't offer those same incentives the next time around, you see? Now, another reason that this shift in bargaining power happens is the learning curve. And remember, I told you that when the company first decides where to invest, it says, we have the experience, we can get the copper out of the ground. We know how to do this. But over time, you see the local people there, they learn how to do that themselves. They move up the learning curve. And they say, we know how to do this. And the government says, you know what, our own people could do this now. They've learned how to do this manufacturing or this mining. We could kick you out of the country and take over. And in fact, sometimes we see that governments outright expropriate or nationalize. They take over the private property of the T&E and decide to do it themselves. They've moved up the learning curve. So even if the government doesn't outright take over, it might start making more demands and say, we don't need you so much anymore, and we have other companies interested in investing here. So that means the government has more bargaining power. Do you see? So the obsolescing bargaining phenomenon has happened. Now, the final reason that this shift in bargaining power happens is the sunk costs. And this is really, I think, the biggest factor. Because what happens is the foreign direct investment that takes place, right? You as an international manager, you're managing the T&E, you decide we're going to put a big investment, a big copper mine in that country. Well, you might sink hundreds of millions of dollars into that investment. And once you have put that huge facility there, that copper mine and maybe a smelting plant and other investments, it's going to be hard for you to pick up and walk away if the government starts putting more demands on you, right? So the government might know this, right? And they realize, wait a minute, they have put so much money, they've sunk so much money into our country, they can't pick up and leave if we decide to raise taxes on them or do something else to them. You see, the government now kind of has you, don't they? They kind of have you by the leg now. I say leg, I said leg, right? So the key thing to notice is that the bargaining power has shifted away from the T&E to the host country government. The obsolescing bargaining has happened. So this is the key thing, I think, to notice. Now, this works very well for copper mining. This is a common phenomenon. It happens again and again. Savvy, smart international managers are aware of this and know how to deal with this. But what about manufacturing? Okay, now here it might be very different. So in manufacturing industries, it might depend on the nature of the technology involved in the industry. So for example, let me give you an example. Let's say there's a transnational enterprise in a very high-tech, fast-paced industry where the technology is changing very quickly, and it's a lot of proprietary know-how, patented, secreted technology. This transnational enterprise, with all of this proprietary know-how, well, it might be very difficult for local people to move up the learning curve, right? So local people, if it's, let's say, Intel, and they're putting a manufacturing plant in Costa Rica or something, I don't think the local people are quickly going to learn how to manufacture microprocessors, right? So the transnational enterprise might retain the bargaining power forever. There might never be an obsolescing bargain in that scenario. On the other hand, if it's a different kind of industry, low technology, there isn't a lot of know-how involved, it might be easy for local people to move up the learning curve. And in that kind of situation, the host country government might quickly develop more bargaining power. So in manufacturing industries and other sectors, a lot depends on some key things. Like, does the T&E have a lot of proprietary know-how that it can keep in secret itself in its own headquarters and not give away to the local people? In that case, the T&E will have a lot of bargaining power. On the other hand, if there's a lot of T&Es all competing, fighting to get into one country, a very interesting case is wind turbine companies all trying to get into the Chinese market. We read about that case in a previous reading. Well, in that kind of situation, the host country government can say, well, there's so many companies that are desperate to get into our market. For example, the government of China might say, you know what? You're all competing to come in here. What can you give us? We can pick one company or another. We can play one company off of another. Who will give us the best terms for investing in our country? And China, for example, has been able to tell wind turbine companies, give away your proprietary know-how to us, share it with our local partners, our local firms, so that we can develop our own wind turbine industry, right? And so that's the way, when there's a heavy competition to get into a particular market, the government can play one T&E off another to get the bargaining advantage. And then a final factor that is really significant in many cases, and in fact, people at Intel Corporation have told this to me many times when they bargain with governments, is how visible is the industry. If it's a high-profile, famous company, like Intel Corporation, for example, and they say, if we go to your little country, if we go to Costa Rica, we're going to give you huge benefits. Other companies will follow us. They know us. People will know that we invested in that country. We'll put you on the map. We'll be an anchor investment that'll attract other investors. Oh my gosh, in that case, the T&E has huge bargaining power, right? And so that public visibility of the company can be a huge asset to a company that is deciding to bargain with the host country government. So this is just the nature of bargaining between transnational enterprises and host country governments. I wanted you to know about this, and I wanted you to know this concept of the obsolescing bargain, because it's a very important concept for any international manager to know.